I'm Drew Nichols. This is my cousin, Darrick Wilkins. We were just talking, and we have been doing business together almost 20 years in the long-term care space. And we haven't done a video where we're together in like 5 years.
Yeah, I mean, he's in California, I'm in Atlanta, so we do a lot of kind of just Zoom type videos, but like our DNA is long-term care insurance planning. We're LTC tree, but what we've noticed over the past, probably 3-4 years, there's a growing demand for what are called equity index annuities to kind of help plan for retirement, generate lifetime income, and just maybe even plan for long-term care.
But I thought annuities were a bad word.
I know, and to be fair, like, let me back up for a second. I got in the industry in 1999 when interest rates were more normal. So, I did long-term care insurance. We also sold quite a few uh, annuities, and there are fixed annuities where it's like a CD. Give us your money, we're going to guarantee you 5% for the next 5 years. Kind of a CD type annuity. But there's also equity index annuities, which give you a shot at earning higher rates than that 5%. I did quite a few annuities up until probably 2006. But if you think back to that, what happened in 2006? That's when interest rates started going down. And then 2007 hit. That was when Lehman Brothers failed. And then it peaked. The financial crisis peaked in like 2008 when I remember that October, the world was on fire. It was really bad. People were panicking. And so interest rates just plummeted. And when that Fed funds rate plummets, these annuities, the interest rates you can get on them really dried up. And so the Fed kept interest rates low until 2022. From 2008 to 2022, interest rates were really low. Thus, these annuities weren't as compelling as they are right now. But once the Fed started raising rates, it just made these annuity offerings a lot more attractive. And that's when our radars kind of went up and said, hey, I'm getting a lot of people asking for more information on annuities. Maybe we should revisit them and learn what's out there. So that's kind of what we've been doing the past few years.
Yeah, we've always tried to find the best tool for the job for our clients. It's still not always annuities by any stretch of the imagination, but more and more it's not a bad word. Like, there's still plenty of actors on the scene who are tricky and all of that, but there actually are some legitimately good options. We were surprised to find out several years ago. Fast forward, the generations of products have improved, and we're at a point now, 2025, where there are half a dozen good options on the market, and we're spending a lot of time. That's actually why we're here in Arizona right now, meeting with some different companies, trying to figure out what is the best option for our clients, what's going to put them in the best spot. We just learned today about a policy from a major company you've definitely heard of that does Social Security protection rider on their annuity. So if there's a docking of Social Security by 3% or more, it triggers a rider that increases your payout on your annuity. So there's all kinds of innovative ways with this crazy future we have coming. You can hedge some of that risk.
Yeah, because I think by 2032, Social Security is supposed to, be bankrupt essentially, and they could be changing some of the terms. And so, it was just an innovative way. This company stepped up and said, hey, if that happens, you got a plan. If you need long-term care, there's also long-term care benefits kind of baked into the cake with some of these products as well. This idea of using equity index annuities to plan for long-term care developed really from the demand of people say, you know what, I want to self-insure my risk. And a lot of people didn't want to pay the premiums. This is called, we kind of think of this as a premium-free LTC. It's like you're not paying a monthly premium to an insurance company and getting nothing back. You're just allocating a portion of your assets into this annuity, and it grows with a ton of different accrediting methods. There's also what is called a lifetime income rider that you can kind of add to these policies. And what that means is you have your money growing indexed to some like an index like the S&P 500 or the NASDAQ. And in a separate account, it's growing guaranteed with the fixed rates being so high right now of anywhere from 8% to 10%, guaranteed for 10, 12, even 20 years. And so if you end up wanting to take a lifetime income, you'll take it off that account. Now, they're not going to give you that account lump sum, but
Not
they'll pay
cash
you
value.
a lifetime guaranteed income. And then the benefit of that is if you outlive your money, if you're worried about outliving your money, this is going to pay X number of dollars for as long as you live. And so that kind of frees you up to be able to take the vacations, give money to the grandkids, go out to eat, enjoy retirement. We want our clients to have fun in retirement.
Yeah, I mean, that's really what it's all about. They come to us to solve a problem, and that is legacy planning, estate planning, those kinds of things, and long-term care planning. And for the time being, may not last forever, nothing does. Some of these fixed index annuities, equity index annuities, are a really solid way to have a guaranteed income as your worst case scenario.
Yeah, that's the floor. Yeah, it's the safety.
That's the floor.
Yeah.
And then your best case scenario is an accumulation aspect. So I really like that element of it. The things like the Social Security protection and even the long-term care rider, you can take it or leave it. I mean,
yeah,
there's 400 of these products. We're out here trying to filter out what are the best options for our clients and their specific needs.
Yeah, and to be fair, I mean, there's a lot of noise in the insurance industry,
yeah,
and a lot of bad connotation. But like our DNA is sifting through it, helping our clients filter out the noise and really funnel down what products out there are worth looking at. Out of the 400 companies, there's probably 10 that we've curated that give you the best shot at earning interest, a good company that you know is going to be around, and at the same time giving you that lifetime income guarantee as the floor.
Yeah, and I mean, a lot of what you're going to hear in annuities sounds too good to be true. A lot of it is too good to be true.
Yeah.
The biggest downside with these annuities is you're locking your money up for 10 years. Like,
yeah,
that's the safest way to think about this. Is if you go with a 10-year contract, that liquidity is gone for 10 years. If you decide you want to, move to Arizona and put a down payment on a house with a pool, that annuity money unfortunately cannot be taken out. So you just have to plan ahead.
Yeah, if there's money out there that you might need a big lump sum, you definitely don't. This is not the right for you. But annuities, they are somewhat liquid. So typically, the annuities allow you to get to 10% of the accumulation value per year for the first 10 years. If you take out more than 10%, they're going to charge you a penalty, essentially. But for clients who have a chunk of money, they take, we're not saying put in half your money. We're saying take 10, 20, 30%. If you know you don't need that, it's a very safe way to grow your money, but at the same time get a shot at much higher rates.
And have a guaranteed floor. If the market crashes 20, 30%, it's going to happen one day.
It is. And shoot, like bonds, some bonds were negative in the past 15 years, which is had been unheard of.
That's pretty crazy.
So, but these fixed annuities, they didn't lose a dollar or a dime because of market losses. So that's the benefit is, if you're okay with the it being only 10% liquid per year the first 10 years, then it might be worth a shot.
Yeah. So, we're out here learning for you guys. We're trying to find the best possible options. We've got new software that we're rolling out. We can do side-by-side comparisons. We're kind of thinking like a top 3 sort of thing.
Yeah.
Stick with the A+ companies most of the time, pretty much all the time. You don't want to put your money with a company that's not.
That's right.
And really, that's kind of what we're doing. If you're curious, like, hey, what could I get? What will my 100,000 buy? What will my 200,000 buy? Whatever it is, give us a call. Check out our website, annuityfacts.com.
Yeah, and we have lifetime income calculators. You can play with the calculator and say, hey, how much money will I have guaranteed for life if I put $500,000 in it? And it'll tell you what your payment would be. Now, these can change, but, as of right now, interest rates seem fairly, I don't see them changing dramatically in the next year. So you probably have a window. Take your time and call us, and we'll happy to kind of fill you in on what's out there.
Yeah, so annuities, they were never a bad word, but they had a bad connotation.
Yeah.
Things have changed. There are some good ones now. Might not always be, but currently, if you're doing long-term care, estate planning, that kind of thing, take a look at them.
Yeah. Anyway, hey, thanks for watching this video. We do these weekly, so come back and check out more. We do kind of focus on retirement planning, whether it's long-term care or planning for living a really long time with these lifetime income and annuities. Thanks for watching.
Thanks for watching.